Hey, cash flow maximizers. I've been getting a lot of questions about how the loans work with infinite banking. And the way that the loans work is fairly simple, but there's a lot more that I think everybody needs to know, and I find myself answering this a lot. So I wanted to go a little bit more in depth so that you guys can understand my thinking around loans in your infinite bank.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
So to start with, let's remember that our infinite bank is a specially designed whole life policy that has guaranteed loan provisions in it, which means you have the ability to borrow from the cash value at any point. And the loan terms are extremely flexible. You don't have a set payback period. You may or may not have a set interest rate. Some of them are fixed, some of them are variable, depends on the carrier. You don't have minimum payments, and you don't have to pay it back if you don't want to or if you're not able to. The reason for that is when you pass away, the loan will get paid back from your death benefit. Since the life insurance company holds that contract, they know that that loan is going to get paid back at some point. Because as of yet, everybody passes away at some point. So they know that it's going to get paid off. So you end up with a lot of flexibility that you just don't have with any other loan product out there. Now, I know some of the other folks who do a lot of talking about private banking, family banking, infinite banking, they like to talk about this loan as if it's something special beyond that. As if paying back this loan does something different than if you're paying back a loan from somewhere else. And I hate to burst their bubble and yours if you're under this impression also. It's not. It's not any different than any other loan out there except for the flexibility. It functions the same way. You have an interest rate that you're charged. That interest that you pay goes to the insurance company. You're borrowing that money from the insurance company, okay? So what some of these other folks talk about is they talk about paying back more than the interest that the insurance company is actually charging you, and that's somehow going into your pocket. And really, that's not true. What's not true is you can't actually pay yourself a higher interest rate going back in. What happens is anything extra that you put into there, you're actually buying paid up additions. So think about it this way. If you have a $10,000 MEC limit and you've already matched that MEC limit, if you put extra money towards a loan out of that policy, there is no room to buy more paid up additions. So you can't do that. What's going to happen is that extra money you put in there is just going to pay down your loan quicker. The money is going to be applied to the loan that you've paid down. Now, if you have room in there, let's say you have $10,000 cash value in there and you have $20,000 of MEC space, now if you're paying back to that policy, any extra interest you pay can go towards paid up additions, which helps you grow your policy, okay? But that's neither here nor there. It has nothing to do with the interest. It's just you putting more money into your policy. I think what doesn't get expressed very well is that what you're really doing is just putting more money into your policy than you would normally have done. It's kind of like deciding to do away with getting a coffee every day and instead putting that coffee into a savings account. This is the same concept. Like, you already think about that money being gone. Same thing with the interest. You're already expecting to pay interest. So if you just expect to pay a little bit more, you can put more into your policy. But it doesn't actually affect the loan, and it's not actually interest going back in there to pay you back. So the point of this is there's nothing magical about borrowing from your policy and paying back to your policy. That loan does not have any special properties to it that somehow grow your money. It's just a loan, just like any other loan, except it has a few beneficial aspects to it. Okay. So when we're thinking about loans, if I'm going to get a loan for a car, I'm not going to be any better off getting a loan from my insurance company than I am getting a loan from a car dealership. Okay. In fact, I could probably get a better loan from the car dealership as far as interest rate goes. So if I can get a 0.9% loan for the car from the dealership, and I have the option of a 6% loan from the insurance company, I'm going to go with the loan from the car dealership because that's a lot lower interest. Now, if I wanted to pay extra interest towards that, I wouldn't actually do that. I would take that extra money and I could put that money into my policy. I would have a much better performing policy if I did that. If I took that 0.9% and figured out what a 6% interest rate would be and I put that extra money towards my policy, I would be better off than if I just got a 6% policy loan. Does that make sense? So when we think about loans, what we think about is you take a loan from whoever it makes the most sense. If you want to maximize your cash flow and the low interest rate from the car dealership is what makes sense, do that. If you don't have the ability to make regular payments, let's say your income is variable and you don't have set income every month, you don't want to be stuck paying a set amount every month or it might hurt your credit, then maybe you want to pay a little higher interest rate and get the flexibility that the insurance company provides. Now, what I would do, if it comes down strictly to cash flow, get the lower interest loan from the car dealership. If you end up in a situation where you can't make the payment for some reason, then pull the money from your life insurance. You still don't have to transfer the full loan from the 0.9% interest to a 6%. You could just pull one payment and make it. Now, you could, of course, do the whole thing if that makes sense to you. Like perhaps you're trying to buy a house and your debt to income ratio is a big factor. That would be a good scenario where you would want to utilize the life insurance policy because that loan is not going to show up on your credit. So there's different scenarios that make it better to choose one over the other. But for the most part, you just need to look at what are your loan options. That about covers the topics I normally have to talk about when talking about loans. If you have any questions about it, put them in the comment section below. I'm happy to clarify or I'm happy to get into more detail on any particular aspect of the loans. So thank you for watching. And if you found value in this video, please hit the like button, subscribe, follow along. We've got more to come.